Hey, good morning, everyone. Marty Mazzora here. It is the 15th of October, 2025. Folks, this will be it for me this week. Won't be back with a commentary until maybe, just maybe, late Sunday, but more likely early next week. I'm going to be going on just a short fishing trip at the end of the week and through the weekend. But with today's world of technology, it's easy to stay connected even when one is away, although it's not easy to shoot a video for clients. So this will be it for now. I want to make this one somewhat meaty, for lack of a better term, and there's so much to talk about. I was tempted to go in several directions, but I thought that this is worth expressing, and that is our view along with two other views, in fact, two competing views about where the economy sits right now, perhaps what that implies for markets, etc. Endgame Macro, someone who spends quite a bit of time on Twitter, who I've started reading, actually does a pretty good job expressing themselves and kind of assessing markets and at least giving a thoughtful view on how they see things. So Endgame Macro's view is one of caution, which I'm going to share with you here in a second, while MRB's actually is pretty upbeat, frankly. And MRB being one of our own premium research providers. And of course, as you know, we do a lot of our own research as well, but we are humble enough to know that we need to test our theses against what other really smart people out there think about the world we live in and markets and so forth. So from me, I personally, immediate term, sit essentially neutral with a slight bearish bias, kind of about macro things in general. Our own economic index shows net weakening in the U.S. economy, while I do see better setups across much of the rest of the world currently. The thing is, if indeed the U.S. sneezes, the rest of the world will catch a serious cold. Also, U.S. equities, we'll still call them Mag 7, are utterly dominant. These are those large cap stocks that just basically dominate both the indexes themselves, particularly the S&P, and the returns of those indexes the last few years. Utterly dominant overweights among foreign portfolios as well. Any hint that, for example, virtually the only reason U.S. GDP has been positive this year, which is AI CapEx, falters or is deemed not to deliver the cash flow in time to support this massive hyperscaler concentration and valuation multiples, we could see the rest of the world sell it like hot potatoes. And this, folks, is a distinct risk out there. Not today, but very much in the coming future. And we will continue to dissect that as we go. That was one of the things that I was tempted to go give you some numbers on today, but we'll have plenty of time to do that as we go forward. Reflexivity is very much the risk right here, meaning the economy reflexively buckles under the weight of a rapidly declining U.S. stock market, a la 2000, versus the more intuitive other way around. So in the late 90s, early 2000s, the dot-com bubble went way beyond where it legitimately deserved to be. A massive crash. NASDAQ index went down 80% over 30 months. S&P went down 50%. And it did force a recession. We weren't necessarily seeing the kind of recession indicators that you might see. We were late cycle, of course. But you could legitimately say the stock market crash was the catalyst. And it wasn't a massive recession, but it was a recession nevertheless. It was a massive mess for stocks, though. Endgame Macro's current view is that things are indeed weakening. The long U.S. Treasury bond, coming with inches of a golden cross, is signaling that the world's largest bond market is beginning to price in the end of the tightening era. Using the TLT ETF, I'm going to illustrate for you what he means by a golden cross. When long-duration treasuries start to base and push higher, it means investors no longer see inflation as a dominant threat. They see slowing growth and more rate cuts on the horizon. The market's whispering what central banks aren't ready to say out loud, that the cycle has turned. 50% drop in gasoline prices is a harbinger for the economy. Gas is one of the cheapest reads on consumer activity and industrial demand, etc. Meanwhile, the currency moves out of New Zealand and Australia. We closely track the Australian dollar. We think it is a good barometer for global industrial growth, China in particular. and that's what they say right here. So when they start cutting rates aggressively and their currencies weaken, it's an early warning sign about the global economy in their view. Put all of this together and you get early formation of a synchronized global easing phase, one that begins in smaller economies and gradually pulls the major players in. Europe's bond market already smells recession. Japan's yield curve is wobbling under its own contradictions. And the U.S., while still the relative safe haven, is starting to show fatigue in the same way it did before past global downturns. So I don't know that I completely sympathize with this, although that may be the signal from Europe's bond market. Europe's data, save for France perhaps, is really beginning to show some signs of improvement, certainly in the soft data. So we'll see how that plays out. Japan has new leadership, and Japan's data isn't so bad either. So they're seeing things there that may very well be valid concerns. Don't know that I completely sympathize, but we'll see. This is a transition, the kind of inflection that only becomes obvious in hindsight. Bonds are quietly coming back to life. The dollar is tightening its grip and commodities are rolling over. Not sure, at least not the last few days anyway. We're moving into a phase where liquidity doesn't expand because central banks want it to, but because the market forces their hand. The global system is exhaling after 2 years of compression, and that exhale always starts the same way, with yields falling, currencies fracturing, and so on. Okay, so for MRB, I'm going to start just with their close to their report that they just published. Final word, more pro-growth policies in Europe area and likely Japan bode well for overall global growth, in contrast to what I just read to you, as well as relative equity market and foreign exchange performance. Stay overweight these regions. Meanwhile, calm benchmark 10-year developed market government bond markets support further upside in global risk asset markets. The uptrend in 30-year yields is an early warning of trouble, but for now, risk on will roll on. Again, this is in direct contrast to what I just read to you, even about the bond market. So here's from another recent report, or it gives you more texture in terms of what they're thinking. Adding it up, good to improving global growth and accommodative developed market monetary conditions should sustain the risk-on phase, although it must be noted that conditions are becoming frothy in many markets. In fact, while Endgame Macro thinks that developed markets, or implies that they should be easing, Macro Research Board, MRB, does not. They think they're making a policy mistake right here. The most likely bearish equity market and credit market catalyst, and this is something I continue to talk about. So if we don't get a slowdown, and instead the big beautiful bill, more stimulus, deregulation, and so forth, pump animal spirits, and we just keep rocking and rolling into next year, the catalyst will be rising government bond yields, like in 2022, i.e. inflation does not come down. The consumer, particularly on the low end of the income distribution, continues to suffer. And very politically unpopular inflation rears its ugly head like it did in 2022, which gave us about a 30% peak to trough downturn. We didn't feel that because we were hedged, but it was a pretty ugly period for the market, and it was more about inflation risk than it was economic risk. So kind of in a sense puts the market, the U.S. market at least, between somewhat of a rock and a hard spot. The surprise ahead could be that it may only take a modest change in the macro backdrop to spark a sizable equity market shakeout for these reasons. As examined in a report earlier this month, there are huge air pockets in some markets, especially in the U.S., AI, and related stocks. And folks, that is not an overstatement, I promise you. To this end, the tech sector's market capitalization vastly outstrips its earnings contribution. Indeed, the sector's share of total U.S. corporate profits has not materially increased in the past 5 years, while its market cap shares have soared. Big question again is all of this massive CapEx, this spending on data center build-outs, the likelihood that it's going to generate the cash flow for these hyperscalers is not strong in our view, and something we were paying very close attention to. Okay, so two competing narratives in the near term. I wouldn't surprise me to see the dips continue to get bought when we're talking about stocks. It's happening today. We're seeing a nice move in our core portfolio because even things like gold and the commodities are having a very nice day today, at least so far. We'll see. Yesterday we had a nice rally that ended up fizzling out at the end, and that was something that the volatility index, the VIX, was signaling to me. And maybe as I go through the charts, we'll see if I decide to talk more about that. Okay, so with regard to the charts, the first commentator above, or the one I shared, talked about a golden cross in bond prices. This is TLT, the long-term Treasury Bond Index, the most liquid one out there. We own some of it. This is the 50-day moving average going above the 20-day moving average. That's the technical golden cross. By the way, not the best technical indicator out there, but it's something a lot of people look at and respect. And this is a buy signal on the MACD. However, this is a bearish divergence in momentum. So this calls into question the bullishness of the pattern up here. And by the way, when you get the opposite, they call that the death cross. And you can see the 50-day moving average dropping below the 200-day moving average. Okay, on to the usual, the S&P 500 daily chart. We've been battling right with this all-time high set back in late September. You can see we shot above that, but this massive candle on Friday's tariff news on China as we bounced against that 50-day moving average. You can see right now it's peeking its head back up above that level as I speak. Still have very bearish divergences in momentum. Not a great look, folks. Not the look, I should say, of a sustainable upside move in markets. We need to blow through these divergences, and they've been very, very stubborn. So time will tell. The NASDAQ 100 index, or the ETF that tracks it, big bearish engulfing candle, trying to fight its way back above its 20-day moving average. Still living with these really long, ugly, bearish momentum divergences that tend to not end well, as I've shown you over the years. The small cap Russell 2000 index today bouncing back above this all-time high level. Looked good here, and then we lost it on Friday. That's a pretty convincing move right now. We need this to pop pretty good too to get confirmation on our momentum indicators, but time will tell. Remember, this was the level back in 2021 where it all failed. So everybody talking about how great the U.S. stock market has been. Well, here's 2,000 stocks that have done virtually nothing in 4 years. But this looks interesting, and this would happen, I think, if indeed the recession scenario does not play out anytime soon and we continue to get more growth. Small cap has a lot of catching up to do, which is why we started adding it right in here. The gold miners that I've been showing you, they are up today as well. Trying to roll over here. That's a pretty ugly bearish engulfing candle. The jury is still out on this. We did cut some exposure, bought some other things that we thought made sense in the near term, but we do like the miners and we do like the metal long term, frankly, in a big way. But right now, these are levels that are just way out over their skis. They are way overbought, and I don't think it would take much of a catalyst to see the precious metal space give us quite a correction, despite the fact that, there's still lots of underinvestment there. And again, I think long term we are going to do very, very well here. I just think short term we need to kind of batten down the hatches a little bit. The dollar, remember back in here, I said it was ripe for a nice technical bounce. The whole world was short the dollar, and sure enough, we've gotten a nice technical bounce, rolling over a little bit here last couple of days, and today I think that's helping risk assets, if you will. And then the 10-year Treasury coming down speaks to the first narrative I shared with you, and that would happen in an environment of potential economic weakness. Folks are buying bonds last 3 days, and this was Friday. You can see they rotated into treasuries a bit, and we're getting some more buying. So this is yields coming down with the bond prices going up. This is a sell signal in the MACD on yield, so that will be very interesting to see. This flies in the face of the second narrative from MRB, but of course this is very, very short-term stuff I'm talking about here. They are making comments about where they think the next few months are going to be going. So folks, I will do a hard stop right there. Appreciate you so much, as always, for watching and listening, and I'll be back early next week. Take care. Bye-bye.